Thank you very much, and particular thanks to Marianne and Tony Garcia, who were brave enough to re-invite me to speak in front of AISD members, because I'm actually German, which means I'm probably the first ever person in Australia who comes from the country who has to pay all of this, and rather from a country who never has to pay about it, which is either British or American, who love to talk about the euro. If you open up your TV set every morning, you watch ABC, Fox News, CNN, CNBC, the more progressive ones will probably see Bloomberg, and you will read International Herald Tribune, Financial Review, Wall Street Journal, whatever have you. Let me ask you, which of those media do pay their people in euro? Well, I didn't ask Alan actually, but funny enough, would you think that if your pocket is pounds or US dollars, would you talk about your own currency where your paycheck is in negatively? No, you wouldn't. So why are you surprised that the Anglo-American press talks so negatively about the euro? Well, let me tell you, I'm trying to give you a positive outlook, and granted, with the news over the last couple of days, it's not so easy to stand here and to be positive about the euro, but I will certainly give you an honest and transparent update. I will talk a little bit about what European investors do generally, talk about the euro area, investors' risk appetite, and to give you an honest review on what I think is going to happen. Europeans are investing mainly in bonds. So the Germans, you actually can call me Bond in this case, because 71% of the asset allocation in Germany is really bonds. It has the highest real return on bonds in the world, because we are sensitized by pretty much 2 inflations over the last 60, 70 years. So therefore, we are very eager to receive a real return. I think the Japanese are number 2. The regulatory framework means that companies, insurance companies and pension funds have to hold 70% of their assets in fixed paper, 30% maximum in equity. The reality is the equity exposure is currently 3% and not more, and about 6 or 7% is in real estate. And if you would do that on a European basis, you would also realize that that bond exposure is actually rather home bias, which means we love to buy our own bonds, which in the case of Italy is positive, because pretty much 90% of the national debt of Italy is owned by its own mafiosi. No, I mean Italian people. So that's actually not so bad, and in Greek it was actually different. More than 120% of national debt was actually owned by foreigners and not the Greeks themselves, because they didn't trust their government. So what happened in Europe? On the 26th of July last year, Mr. Draghi, who by the way is an Italian, made the statement that the EC books would be opened and they would buy anything which would come out of the governments of the PIGS. PIGS being Portugal, Ireland, Italy, Greece, and Spain. Okay? So that has changed tremendously the assumption or the feeling of investors regarding risk. So when you look at the performance of some of the riskier papers, mainly Portuguese bonds, Spanish bonds, Italian bonds, you can see they have had a fabulous performance. These are numbers from the 26th of July last year to the 8th of March this year. And Portugal has a performance of 57.6%, which I'm sure you would love in your super fund. Spain, 21%, and even German equities had some of 21% at the time. So people seem to think the problem is over until last weekend. The question is that fundamentally driven? Because if central banks open their checkbooks, that usually helps. So liquidity is there, plus thanks to the ECB, there's also solvency there for all of these countries other than Greek, who's off the capital markets these days. And you can see the expansion of the balance sheets of these central banks have led, at least in part, to a significant support of the markets. But is really the Eurozone, which by the way has 17 countries of 27 in the European Union, and by the way, the European Union has 502 million people in its area, and a debt to GDP currently of 85%, versus the United States, which has 317 million people and has a debt to GDP of 111% as we speak. And I'm sure George says something to this later. So what has happened? Investors seem to believe they can invest in those governmental bonds again. Spreads came in, default CDS prices came down versus the German bonds. So obviously everything back to normal until last weekend. However, in the underlying economy, you actually do have improvement. Are they significant? On a relative scale, they are very significant, but they're by far strong enough to help those countries to get over the hump. If you look at Greece, it's not just that their imports declined, which is obvious if nobody has any money to spend anymore and your annual or monthly wages are being cut by 25 to 30%. However, the exports of those countries have gone up double-digit. Greece 38%, Spain 25%, Italy more than 20%. By the way, Italy is the third largest machinery producer in the world, and remember, emerging markets, which I'm sure you will hear recommendations about, need machines, Germany and Switzerland being the other two. So effectively, there is an improvement in the trade balance as well. And now let me get to the famous question of euro-dollar. I just read a news on Bloomberg which says euro on a 12-month low against the US dollars. Well, you know what? Over the last 52 weeks, the euro lost 2.71%, 2.68% against the US dollar. And if you would think, at the beginning of 2010, the euro was 140 against the US dollar. At the beginning of 2011, it was 131. At the beginning of 2012, it was 129, and today it's 128.8. So you would imagine in the worst of ever news and PR work against a currency, nothing has happened. Pretty much nothing has happened. And I made this point actually pretty much a year ago, and I see Gerard, if I see him correctly. Thanks. Hello. Thanks for having me at that time. And literally, there seems to be enough skeptics in the world who believe it's not just the euro who has a problem, it's also the US dollar who has a problem. And the hairy guy up there in the video, which was me, I took it off for you, did give you the wrong number. Actually, 62% of world currency reserves is in US dollar as of now, and 26% is still in euro. But you yourself are penalized by the fact that international investors, and I'm sure you can talk about this a lot, do not believe they should put even more money in the US dollar because your currency, the Swiss franc, the Danish krona, are being used as sort of exit not to invest more money into the euro and not to invest more money into the US dollar. So I think that seems to be an indication that there is sufficient enough question marks regarding US development. I'm very positively surprised because otherwise I thought that was the result of my speech, that you think the euro will survive. But we get to it. Okay, is it still a long way to go? Absolutely. I think the worst what we have to go through is the fact that your observation is basically dominated, number one, by journalists, I apologize, number two, by politicians. Politicians would love to form an even stronger framework of the European Union. The European Union, however, is in effect lived by its 500 million people every day. They don't give a about Brussels. What they really care about is that they can travel easily. They have not to stand in front of an immigration officer to grant their visa, to either go in a lottery for the green card in the United States. They can just walk and drive over the border and work in Germany. What's really the problem in Europe is we have some countries with 50% unemployed young people. On average, 25% of the people below 25 are actually unemployed. That's the real problem we have. So what do we have to do about it? One thing, if you're all linked into one currency, you have to do what we call internal depreciation. So labor costs in Germany have to go up, and they are going up. Currently, the demand is 6.5% on the current demand for the IG metal, which, by the way, is the largest union in the world with 3.8 million members. And at the same time, you're declining labor rates in Spain, in Italy, in Greece. Greece, I mentioned 25% already. So that's positively. Productivity will go up therefore slowly, but it is going up. The real problem, and there comes my big hope for George and the American economy, is that the Americans get their act together faster than we. And actually, I do believe it's great if the Fed continues to buy this stuff, because that will basically support the economy. And if the US grows 3%, private consumption in the US which stands for 67% of its GDP versus 67% in the UK services, and 67% of the GDP in Germany is industrial production. So if the Americans are consuming, the Chinese and the Germans are very happy. Therefore, we need the Americans, we need the rest of the world economy to really reactivate, and therefore then basically be able to export again. So the growth factor is really a problem we have. Risks remain high. We talk about Cyprus. And by the way, to put Cyprus into perspective very quickly, the city of Detroit has 700,000 people and has a debt of 15 billion. Okay? The country of Cyprus had 1.1 million people and has a debt of 15 billion. So just to put things in perspective. Do you think if we are all people from New York and Massachusetts, okay, and you can now elect and vote, if you would like to pay the debt of California, would you say yes or no? See? Fact is, we Europeans do have a choice. So if we voice ourselves and said, listen, I'm not really want to pay the debt and the misbehavior of somebody in Cyprus, that's just normal. In the United States, that is never discussed because you cannot ask the question. Again, referring to my comment of 1 Washington and 27 Washingtons in Europe. So we don't have a choice. France still is a huge problem, unquestionable. But, you know, take the UK as an example, and I'm sure a lot of you have connections in the UK. It actually doesn't need for them to be a member of the UK to go bankrupt. They can do it themselves. Honestly, I don't even know what he's worrying about. The referendum was tactically done because he wants to be re-elected. If once he is re-elected, he has a choice of very bad choices. Either he stays with it, because currently, no matter if he has the currency or not, he has to pay anyway because he's part of the guarantee. Germany alone takes a guarantee of 1,200 billion euros, which is, if worst comes to worst, right now in the European zone, is the maximum guarantee, which is exactly half of the national debt of Germany as of now. It's not going to happen, don't worry about it, but I think I just wanted to give you the dimension. So the UK and France is a problem, but Italy is a problem as well. And I apologize, the ladies, I didn't know that's the middle finger. So when I put in the photograph. Fact is, 25% of the voters in Italy voted for a comedian. You could say that about a lot of politicians in the world, I believe that, but actually he is a comedian. Pepe Grillo is a comedian on TV. The other one is a clown. No, this is Berlusconi. So fact is, if you then add 25% of non-voters in Italy, pretty much 2/3 of the Italian people have voted against the reforms which Mr. Monti, the famous boring professor, applied, which he obviously didn't do voluntarily because he was forced by the Troika. So there is a political gridlock in Italy, and Italy, by the way, has a national debt outstanding close to what Germany has, which pretty much half the people. So that's the real problem. France and Italy are the most significant problems, and that's why a Cyprus potentially is not really important at all. We can drop it, it's actually cheaper if we drop it, but keep in mind all this wow of the commentaries of international TV commentaries who actually recommended for people to go to the ATM. Quite honestly, I consider this irresponsible. And this was on national TV in Australia yesterday, that all the American commentaries in today's morning show and whatever have you said, I would go to the ATM the next day in Spain, Greece, and I would take my money out. This is irresponsible behavior. It's just not right. It's not right to take the small people's money, absolutely. Therefore, I think it's fine if they voted no. But I think it's certainly not right to go up in public and recommend a bank run, because that's going to hurt all of us. So, well, now I killed something. The problem really in Europe is not really the people. Believe me, 10 out of 17 governments have been voted out of office since this crisis began. And by the way, the European debt crisis is not a crisis as such alone. The debt crisis existed as a result of the financial crisis, because the over-indebtedness already existed. It added the rescue packages for all the banks, and then it became transparent that those countries were actually already bankrupt. So therefore, there is a vicious circle of crisis since 2007, 2008, who potentially started, maybe in the US, it's subprime, but basically sort of did a globalization and ended up with a very transparent debt problem. And by the way, the debt problem is not just in Europe, it's just more openly discussed in the United States. Remember the cliff in January and now in March or May, whenever it's coming. So both of the major regions of the world have significant problems. Well, what's happening with Euro? With Europe, the EU will survive, no question about it. There is this clear north and south element there. Second, yes, there is integration of debt mutualization. All these organisms, EFSF, ESM, which I cannot pronounce, will actually be happening, are happening as we speak. So economical disintegration is a fact. We don't have to talk about this with the South. Now comes the more difficult question, and quite honestly, I cannot give you an answer. I don't believe that, at least in the time where I will be living, that we will see a political union. But the European Union as such, as a fact, as free travel across those borders, free labor across those borders, will not go away. Fiscal union, and I apologize with the ladies, I think we pretty much have pregnant, because I think if the EU as such, as a body, has to take a joint risk for countries in difficulties, I think there has to be some kind of income stream there. Sorry, I always push the wrong button. Economic growth is really the issue. It's shaky, and it's obviously very much depending on the world growth. So volatility remains, and I think what you have to understand that globally, all governmental debt is credit. All governmental debt is credit. So don't treat it as a secure, as something which cannot default, whatever. Governments are highly indebted around the globe. There are a few exceptions, but I think you have to treat it, which recommends you active management, by the way. This is the marketing part of my presentation. What's the conclusion? Investors' confidence has to be restored, and I think the ECB is certainly helping. Economical fundamentals are weak in the region, but they are improving. And the austerity and structural reforms are necessary to overcome the problems. The periphery is not just the credit, it's also the rest of Europe is the credit. But keep in mind, what is the option? Let me give you a vision how some politicians like to see the world in the next 30 years. China does all the industrial production, India has all the services, the US has all the debt, and Europe is the museum where everybody comes to travel to look at the old shit as it existed. Okay, thank you very much.
Thank you for inviting me. 155 years ago, in 1858, my great-grandfather immigrated from Germany. I guess I'm glad he did. The sad part was 4 years later, he was drafted into the Northern Army and fought at Gettysburg, but survived and lived into his 80s. Before I kind of offer some insights or views on U.S. markets, I thought I might have a few disclaimers. One, I've been at this for a long time, 40 years, so I'm a lot more insightful about the past than the future. Secondly, our firm, Singular Guff, is one of those dreaded private equity firms that lays off millions of people to make Mitt Romney rich, so we don't do much in public markets. And the third thing is that we don't trade stocks, we don't trade bonds, we just invest to create jobs and build companies. The firm was founded 18 years ago, and as I say, we only invest in private equity, but notwithstanding our views on America right now, where about half our money is, we have offices in Shanghai and Mumbai and Sao Paulo in Russia, and we do have kind of a global perspective on things. And as bad as things may seem here, we were fully invested in Russia in 1998, and had dollar investments in a number of companies where we had ruble revenues and ruble profits, and we had a 75% devaluation in one day. And so we saw a lot of wealth evaporate. But the interesting thing was 5 years later, we had a double on dollar basis, not Russian basis, and we got out of it. So we've learned to live through volatility. kind of to put background and context, beyond Singular Gulf, I do a couple other things that are relevant to my thoughts and such. I'm on the board of MSCI, and many of you look at and see MSCI as the producer of the indices that you often follow, but also has risk metrics and Barra for risk assessment in a quantitative sense. And particularly important down here, and important for me, it owns ISS, which is Institutional Shareholder Services, which does the proxy services that are important. A lot of my insights, I'm on the investment committee for the IMF's pension fund, and you get to meet with some really smart people there, and probably the most important meetings I go to every year. And lastly, I'm on the board at the Hoover Institution at Stanford, where Milton Friedman spent the latter part of his career, and George Shultz, Condi Rice, John Taylor. So my economics is a little bit to the conservative side. The history starts 40 years ago when I was a young analyst and recent grad of business school, and George Putnam, the then treasurer of Harvard University and also head of the Putnam Funds, hired me with a project to try and write a business plan for this idea he had to create a money management firm independent of anyone else, solely to manage the assets of Harvard University. The initial goal was to reduce costs, something that's near and dear to your heart. But it also gave you an element of control. People who came to work there had a strong commitment, and we had both continuity and creativity. And we tried to overcome the goal of creating wealth for assets and the goal of building an asset management firm also diverge. It took us a year to put the task together and assemble a team, and everybody recognized it in Boston press that we'd created the best and brightest going. We had the head of portfolio managers from Wellington, the head of research from Alliance Capital, now Alliance Bernstein, director of research from the Bank of Boston, the best bond manager in the country. We took over the money on July 1, 1974, and 90 days later we lost 1/3 of it. So the Harvard endowment went from $1.2 billion to around $800 million. A little bit of luck, a little bit of maturity. The group didn't panic, and slowly but surely the market came back. And now 40 years later, that $800 million is $35 billion. During that time, we got some gifts. We also spent 4 to 5% a year to run the institution. And it showed us what true volatility could be, but also what long-term investing is. I cite the 40-year number because someone earlier today said that the superannuation business will reach its maturity in 40 years, and I think it's important to look back at how that happened. The U.S. markets, as bad as we may think things are, as frightening as they are, from the Harvard endowment perspective, from 1966 to 1982, the endowment lost 80% of its value and purchasing power. We lived with 18% government long bonds. We lived with 22% prime interest rates, and we looked like we were spiraling out of control. It was also 40 years ago that modern portfolio theory began to come into its own. Burt Malkiel wrote The Random Walk. He used a lot of data to prove that active management was almost impossible to beat. And some of those concepts really found their way into how Harvard ran its money in terms of diversifying into venture capital or various hedge fund-like trading strategies, private equity, real estate. And so for me, investing is a lot about finding those inefficiencies. And certainly there are inefficiencies to be had now. One of the cases you can make for Europe right now is just European distressed debt is going to get restructured and be done at relatively attractive prices. What does long-term mean? Today, you're $1.6 trillion in assets. Do the math. It won't be long before you're at $5 trillion. You're going to max out more than $10 trillion. And this is the key foundation of your economy and your democracy. I mean, these are the most important dollars your country will have. It will modify people's behavior. It will incentivize people to work. It will keep your country cohesive, and you're charged with that responsibility. So. Now the U.S. The U.S. economy is a mess, but it is in a recovery. It's going to be slow, but it's moving in the right direction. I'll give you a good reason to come to conferences. In the spring of 2006, I was asked to speak at the Institutional Investor Conference in Boston and to talk about what I thought was the coming crisis in high-yield corporate debt in the United States. And I had my charts and presentations ready and such. And Speaking with me on the same panel was a fellow who had been doing a lot of work about coming credit issues as well, but he was focusing on the housing industry. The fellow's name is a little bit more familiar now than back then, named John Paulson. And I listened to John and took it in, and 12 meetings later, we were the second biggest investor in shorting Trump Prime with John Paulson. So there are a few investors here that benefited from that. But we saw a crisis coming. But the excesses that were built into the system in derivatives then were hard to imagine, the uncontrollable excesses. There was a vehicle then called a CLO squared. Now, a CLO, many of you know, is a collateralized loan obligation. You have 1,000 mortgages on single-family homes. They're all first mortgages. You put them in a pool, and the pool is the credit behind it. So you go to a rating agency, and they say the top 70% is AAA, the next 10% is AA, 5% is single A, 3% triple B, 2% single B, a little bit of equity underneath it. We sell it into the market. Spreads are narrow, so the AAA piece sells for 35 basis points over comparable maturity treasuries. Okay idea, presumes housing prices always go up, but insatiable demand for yield. So the creativity of Wall Street goes out and creates a CLO squared. So what do? You take the triple B tranche of a CLO, and then you take another triple B tranche and another one until you have 50 triple B tranches. So you're pretty far down the cap structure, 50 times, homogeneous asset. You take it to the rating agencies, guess what? The top 70% is AAA. The next 10% is AA, and you get down to the triple B side, it's trading at 90 basis points over treasuries. What that means is the spread from treasuries is the cost of a credit default swap. I mean, it was a sucker bet. I mean, there was just no way that the housing prices were going to continue to go up. So in any event, that was the shoe that lost the horse, that lost the rider, that started the global financial crisis. How do we look today? It's been a rough ride. I think that a lot of very tough decisions were made by a lot of people who were doing things for the first time in a pretty courageous way. I think the other Hank Paulson, reached deep and convinced Congress to create a TARP program where there was $750 billion made available to prop up bank equity. Tim Geithner with him and such. Coordinated just a global meltdown and freeze of interbank assets. You proudly say down here that you have good, solid banks, which you do, but they also needed a big infusion from the New York Fed to create liquidity through that process. Today, it's 5 years later. I think that the problems we have are far from solved. The U.S., in 2007, the year we did subprime, the U.S. deficit was $170 billion. We haven't had a year since then that was under $1 trillion. And we've taken U.S. debt, I guess, I was going to say 17 trillion. You said it was 18 trillion, but it's at a level that it rivals that of the peak of World War II. Our other problems are our Social Security system. Interesting enough, I did a detour for a couple years in the Reagan administration where Social Security and Medicare reported to me. We had about 115 million people paying in and about 35 million paying out. But it's always been a pay-as-you-go system. And the unfunded liability there is about equal to our debt. The promise that our government makes and what we call entitlements is such that if you retire this year and you started working when you graduated from high school, probably in 1965, and you're married, and you never earned above median income, so you earned $55,000 last year or something, the day you and your wife retire, the government owes you present value $1 million. We have about 8,000 people a day retiring. And that $1,000 also includes your health insurance as a retiree. How do you fix this? There are only 4 ways a government can fix things. They can spend less, tax more, grow or inflate. And my guess is we're going to have some combination of the bunch. Can we effectively deleverage? Can we grow? Can we make these things happen? I think we have to. I think, for all you see and hear about, the fiscal cliff and sequestering and debt defaults and the like, and the partisanship going on, it is an ideological difference, but I don't think either side is crazy enough to ever fully execute on it. The good news, I guess, is that we're having a total transformation, if not a revolution, in energy in the United States. Natural gas is $3 an MCF, about a quarter of world price. We're seemingly discovering an endless supply. Obviously, when you see the paper every day, West Texas crude versus Brent is on $20-some differential. We are rapidly becoming self-sufficient for oil. That has all kinds of ramifications for the Middle East, Gulf, and the like. We're also globalizing. My recommendation for stock investors is just look at great global companies. Today, the Boeings of the world, the United Technologies of the world, the Johnson & Johnsons of the world, or even the Nestle's of the world or Unilevers are just uniquely attractive assets. They're trading at 12, 13, 14 times earnings, 8 or 9 times cash flow. They've got great balance sheets. Our corporations are sitting on $2 trillion worth of cash. Some of it is offshore, but a lot of it is onshore. And that money is there to be deployed as the economy recovers and confidence restored. So on balance, I'm sanguine. Part of it comes from what we do in private equity. We have about 250 small companies that we've assembled an ownership position in businesses in the United States that are distributors of filters or the manufacturer. We're the largest baker of croissants in the United States. We just sold a company that was Patty, the firm that if you ever went scuba diving, license you and registers it. All kinds of nuts and bolts, 400,000 companies like this in the United States. And they grew throughout the recession. Our portfolio, we started the recession with 45,000 jobs. We ended up with 54,000 jobs. So in the midst of these layoffs and the like, we sustained real growth. And they're kind of our canary in the coal mine, and life is getting better for them. They're starting to spend on CapEx. They're starting to hire. And so it gives us some cause for future optimism. Your challenge here is obviously to deploy an ongoing amount of inflows of capital. And as I say, I think that the notion that there are interesting places to go right now has never been better. The demise of China has been articulated many times with the fact that it's not happened. I think Xi Jinping is going to deliver growth and stability for the next 3 or 4 years, just because that's the nature of how they do things. And I do believe things are getting better. Thank you.